Question 1. Market research demonstrates a significant shift in customer preferences towards digital-first insurance services, necessitating a strategic overhaul of the firm's customer interaction channels and internal operational processes. As a senior leader, which of the following approaches best balances the need for rapid adaptation with the imperative to maintain regulatory compliance and ethical standards? Option A. Implement a phased rollout of new digital platforms, accompanied by comprehensive staff training and clear communication campaigns to all stakeholders, while establishing a dedicated compliance review team to monitor each phase against regulatory requirements. Option B. Initiate an immediate company-wide transition to a fully digital model, decommissioning all traditional customer service channels overnight to maximize efficiency gains and capture emerging market share. Option C. Prioritize cost reduction by significantly reducing customer-facing staff and automating as many processes as possible, with minimal upfront communication to employees about the long-term vision. Option D. Delegate the entire change process to the IT department, allowing them to implement new technologies as they see fit, with the expectation that operational and regulatory concerns will be addressed retrospectively. Correct answer is A. Implement a phased rollout of new digital platforms, accompanied by comprehensive staff training and clear communication campaigns to all stakeholders, while establishing a dedicated compliance review team to monitor each phase against regulatory requirements. Explanation: this scenario is professionally challenging because implementing significant changes within an insurance firm requires careful consideration of both internal operational efficiency and external regulatory compliance. Leaders must navigate the complexities of employee resistance, maintain service quality, and ensure all actions align with the regulatory framework governing insurance operations. The chosen change management approach directly impacts the firm's ability to adapt while upholding its legal and ethical obligations. The correct approach, which involves a structured, phased implementation of change, is right because it aligns with the principles of responsible leadership and regulatory oversight. Specifically, it mirrors the iterative and communicative nature of effective change management models like Kotter's 8-step model, which emphasizes building a guiding coalition, creating a vision, communicating it, empowering action, and anchoring new approaches in the culture. This structured approach allows for feedback, adaptation, and ensures that all stakeholders are informed and engaged, thereby minimizing disruption and fostering buy-in. From a regulatory perspective, this methodical process helps ensure that changes do not inadvertently lead to breaches of conduct rules, data protection regulations, or solvency requirements, as each step can be reviewed for compliance. Ethical considerations are also met by treating employees with respect through clear communication and involvement. An incorrect approach that bypasses thorough planning and communication would be professionally unacceptable. This could lead to confusion, resistance, and a breakdown in operational processes, potentially resulting in service failures or non-compliance with regulatory reporting or customer protection rules. For instance, a Big Bang approach without adequate preparation or stakeholder consultation could violate principles of good governance and risk management, as it fails to adequately assess and mitigate potential negative impacts on the business and its customers. Such an approach could also be seen as a failure to act with due skill, care, and diligence, a core principle in many regulatory frameworks for financial services professionals. Another incorrect approach might involve implementing changes solely based on cost-saving imperatives without considering the impact on customer service or regulatory adherence. This could lead to a breach of regulatory obligations related to customer best interests or fair treatment. For example, reducing staffing levels without a corresponding review of workload capacity or customer contact protocols could result in delays in claims processing or inadequate advice, contravening regulatory expectations. A third incorrect approach could be to implement changes without involving key stakeholders or seeking necessary approvals, thereby undermining the principles of transparency and accountability. This could lead to internal conflicts and a lack of buy-in, making the change unsustainable and potentially leading to breaches of internal governance policies and external regulatory requirements for robust internal controls. The professional decision-making process for similar situations should involve a comprehensive impact assessment that considers operational, financial, regulatory, and ethical dimensions. Leaders should adopt a change management framework that prioritizes clear communication, stakeholder engagement, risk mitigation, and continuous evaluation against regulatory standards and ethical principles. This involves understanding the specific requirements of the relevant regulatory body, e.g., the Prudential Regulation Authority or Financial Conduct Authority in the UK, and ensuring that all proposed changes are assessed for their potential impact on compliance, customer outcomes, and the firm's financial stability. Question 2. Regulatory review indicates a potential discrepancy between a long-standing internal underwriting practice for a specific type of policy and the current statutory requirements in several key states where the company operates. The practice has been in place for over 5 years and has not previously drawn regulatory attention. What is the most appropriate course of action for the Chief Underwriting Officer? Option A. Immediately halt the underwriting practice in all states and initiate a comprehensive review of all underwriting guidelines to ensure full compliance with all applicable state regulations, engaging external legal counsel specializing in insurance law for guidance. Option B. Implement minor adjustments to internal documentation to reflect the current practice, without altering the practice itself, and inform the underwriting team that the review is complete. Option C. Proactively communicate the company's underwriting practice to the regulators in the affected states, requesting clarification on its compliance status without initiating any internal changes. Option D. Assume the practice is compliant due to its longevity and lack of prior regulatory issues, and instruct the underwriting team to continue as usual while monitoring for any future complaints. Correct answer is A. Immediately halt the underwriting practice in all states and initiate a comprehensive review of all underwriting guidelines to ensure full compliance with all applicable state regulations, engaging external legal counsel specializing in insurance law for guidance. Explanation. This scenario presents a common challenge for insurance leaders, balancing the need for efficient operations with the imperative of strict regulatory compliance. The professional challenge lies in interpreting and applying complex state-specific insurance laws, which can vary significantly, to a business practice that has become standard within the company. A leader must not only identify potential noncompliance, but also devise a strategy that rectifies the issue without unduly disrupting business or alienating stakeholders. This requires a nuanced understanding of both the letter and the spirit of the law, as well as strong ethical judgment. The correct approach involves a thorough, proactive investigation into the specific state regulations governing the practice in question. This entails consulting legal counsel specializing in insurance law for the affected states and developing a remediation plan that addresses the identified compliance gaps. This approach is correct because it prioritizes adherence to the law, protects the company from potential penalties and reputational damage, and demonstrates a commitment to ethical business conduct. By engaging legal experts, the company ensures its understanding of the regulations is accurate and its remediation plan is legally sound. An incorrect approach would be to dismiss the findings of the regulatory review without further investigation, assuming that the practice has been acceptable for a long time. This fails to acknowledge the dynamic nature of regulations and the potential for evolving interpretations or new requirements. Such inaction constitutes a significant regulatory failure, as it neglects a direct indication of potential noncompliance and exposes the company to penalties, fines, and potential license revocation. Ethically, it represents a dereliction of duty to operate within legal boundaries. Another incorrect approach would be to implement a superficial fix without understanding the root cause or the specific regulatory requirements. For example, simply updating internal documentation without changing the actual practice would not resolve a substantive compliance issue. This approach is flawed because it does not address the underlying problem and therefore leaves the company vulnerable to continued noncompliance. It is a form of regulatory evasion rather than genuine correction. A third incorrect approach would be to implement a drastic, company-wide change based on a single state's regulation without considering the nuances of other jurisdictions. While a proactive stance is good, a one-size-fits-all solution can create new compliance issues in other states or impose unnecessary burdens on operations. This demonstrates a lack of understanding of the state-specific nature of insurance regulation and can lead to inefficient resource allocation and unintended consequences. The professional decision-making process for similar situations should begin with acknowledging and taking seriously any indication of regulatory concern. The next step is to gather all relevant information, including the specific regulations cited and the company's current practices. This should be followed by consultation with qualified legal counsel to interpret the regulations and assess the company's position. Based on this expert advice, a comprehensive and actionable remediation plan should be developed and implemented, with clear accountability and timelines. Finally, ongoing monitoring and review are essential to ensure sustained compliance. Question 3. Governance review demonstrates that the insurance company has a strong digital platform and a highly experienced compliance team, but faces increasing competition and a recent increase in customer complaints related to policy administration. The leadership team is considering strategic options to address these challenges and capitalize on market trends. Which of the following approaches best utilizes the SWOT analysis to guide strategic decision-making in compliance with UK regulatory expectations? Option A. Initiate a significant reduction in compliance staff to reallocate resources to product development, believing that a more competitive product offering will indirectly improve customer satisfaction and reduce the need for extensive compliance oversight. Option B. Focus solely on aggressive marketing campaigns to capture market share from competitors, assuming that increased revenue will provide the resources to address any future compliance issues that may arise. Option C. Prioritize the development of new, complex insurance products to differentiate the company, without a thorough assessment of the compliance team's capacity to manage the regulatory risks associated with these novel offerings. Option D. Develop a strategy to leverage the digital platform to streamline policy administration, thereby reducing operational costs and improving customer response times, while simultaneously investing in enhanced training for the compliance team to proactively address emerging regulatory changes and customer service standards. The correct answer is D. Develop a strategy to leverage the digital platform to streamline policy administration, thereby reducing operational costs and improving customer response times, while simultaneously investing in enhanced training for the compliance team to proactively address emerging regulatory changes and customer service standards. Explanation: this scenario is professionally challenging because it requires a leader to move beyond a superficial understanding of a SWOT analysis and apply it strategically within the specific regulatory context of the UK insurance market, as governed by the Financial Conduct Authority, FCA, and the Prudential Regulation Authority, PRA. The challenge lies in translating the theoretical framework of SWOT into actionable insights that address both business objectives and regulatory compliance, ensuring the firm's long-term viability and customer protection. A deep understanding of the regulatory environment is crucial to identify threats and opportunities that are specific to regulated entities. The correct approach involves leveraging the SWOT analysis to identify specific, actionable strategies that align with the firm's regulatory obligations and strategic goals. This means not just listing internal strengths and weaknesses or external opportunities and threats, but critically evaluating how these factors impact the firm's ability to meet its regulatory objectives, such as the FCA's principles for businesses or the PRA's Solvency Roman II requirements. For instance, a strength might be a robust IT infrastructure, which can be leveraged to enhance regulatory reporting efficiency and opportunity. Conversely, a weakness in staff training could pose a threat to compliance with conduct regulations. The correct approach prioritizes actions that mitigate regulatory risks and capitalize on opportunities that enhance compliance and customer outcomes, thereby demonstrating sound governance and a commitment to regulatory adherence. This aligns with the FCA's focus on treating customers fairly and the PRA's emphasis on prudential soundness. An incorrect approach would be to focus solely on market share or profit maximization without considering the regulatory implications. For example, pursuing an opportunity for rapid expansion without adequately assessing the firm's capacity to maintain compliance with regulatory requirements across new markets would be a significant ethical and regulatory failure. This could lead to breaches of conduct rules, inadequate capitalization, or poor customer outcomes, all of which are serious concerns for the FCA and PRA. Another incorrect approach would be to ignore or downplay identified weaknesses that have regulatory implications, such as a lack of robust internal controls. Failing to address such weaknesses, even if they don't immediately impact profitability, creates a significant risk of future regulatory breaches and reputational damage. This demonstrates a lack of proactive risk management and a failure to uphold the firm's duty of care to its customers and the integrity of the financial system. The professional decision-making process for similar situations should involve a structured approach. 1. Thoroughly conduct the SWOT analysis, ensuring all identified factors are considered in the context of the UK insurance regulatory landscape. 2. Prioritize identified factors based on their potential impact on regulatory compliance, customer outcomes, and prudential soundness. 3. Develop strategic initiatives that directly address high-priority weaknesses and threats and leverage high-priority strengths and opportunities. 4. Integrate these strategic initiatives into the firm's overall business plan and risk management framework, ensuring clear accountability and regular monitoring. 5. Regularly review and update the SWOT analysis and associated strategies to adapt to the evolving regulatory and market environment. Question 4. The performance metrics show a decline in the team's adherence to new anti-money laundering reporting procedures, despite recent training. The team is composed of individuals with varying levels of experience and engagement. Considering the principles of effective leadership within a regulated environment, which approach would best address this situation? Option A. Adapt leadership style based on the specific demands of the situation and the characteristics of the team members, ensuring clear communication of regulatory expectations, and fostering an environment conducive to compliance. Option B. Focus exclusively on individual performance reviews, identifying those who are not meeting the new reporting standards and implementing disciplinary measures without considering the broader team dynamics or leadership approach. Option C. Maintain a consistently task-oriented leadership style, emphasizing strict adherence to reporting deadlines and procedures, regardless of individual team member needs or situational nuances. Option D. Prioritize building strong interpersonal relationships within the team, focusing on team morale and open communication without explicitly reinforcing the importance of the new reporting procedures. The correct answer is A. Adapt leadership style based on the specific demands of the situation and the characteristics of the team members, ensuring clear communication of regulatory expectations and fostering an environment conducive to compliance. Explanation. Scenario analysis. This scenario presents a common leadership challenge within the insurance sector, where a leader must adapt their management style to varying team dynamics and situational demands to ensure regulatory compliance and optimal performance. The challenge lies in recognizing that a single leadership approach is unlikely to be effective across all situations and team members, necessitating an understanding of contingency theories. Failure to adapt can lead to decreased team morale, reduced productivity, and potential breaches of regulatory requirements related to conduct and oversight. Correct approach analysis. The correct approach involves applying a contingency theory of leadership, such as Fiedler's contingency model, which posits that effective leadership depends on the match between the leader's style and the situation. In this context, the leader must assess the specific demands of the current regulatory environment, the task structure, e.g., routine vs. complex compliance tasks, and the leader-member relations within the team. If the situation is highly structured and the leader has good relations, a task-oriented style might be effective. Conversely, if the situation is less structured or relations are strained, a relationship-oriented style might be more appropriate. This adaptive approach aligns with the Financial Conduct Authority's (FCA) Senior Managers and Certification Regime (SM and CR), which emphasizes individual accountability and the need for leaders to demonstrate competence and appropriate conduct in managing their teams and ensuring compliance with regulatory obligations. By tailoring their leadership style, the manager can foster an environment where team members are more likely to understand and adhere to regulatory requirements, thereby mitigating risks and ensuring the firm's integrity. Incorrect approaches analysis. Adopting a universally task-oriented leadership style, regardless of team dynamics or situational complexity, would be incorrect. This approach fails to acknowledge the human element and the varying needs of team members, potentially leading to demotivation and a lack of engagement with complex compliance procedures. It could also result in overlooking subtle compliance risks that a more relationship-oriented leader might identify through open communication. Such a rigid approach could be seen as failing to exercise appropriate oversight and management, potentially contravening principles of SM and CR that require senior managers to ensure their teams act with integrity and competence. Conversely, adopting a universally relationship-oriented leadership style without considering the task structure or the need for clear direction on regulatory matters would also be incorrect. While fostering good relationships is important, an overemphasis on this aspect without ensuring clarity and adherence to strict compliance protocols could lead to a lax environment where regulatory breaches might occur due to a lack of clear expectations or accountability. This could also fall short of the FCA's expectations for effective governance and control, focusing solely on individual performance metrics without considering the broader situational context or the leader's own style would be an incomplete approach. While metrics are crucial, understanding the underlying reasons for performance, which are often influenced by leadership style and situational factors, is essential for effective management and regulatory compliance. This narrow focus might lead to misdiagnosis of performance issues and inappropriate interventions, failing to address the root causes that could impact regulatory adherence. Professional reasoning. Professionals should employ a decision-making framework that integrates situational analysis with leadership theory. This involves 1. Accurately assessing the current situation, including task complexity, team maturity, and external pressures, e.g., regulatory changes. 2. Understanding different leadership theories, particularly contingency models, to identify potential leadership styles that might be most effective. 3. Evaluating their own leadership tendencies and flexibility. 4. Adapting their style to best suit the identified situation and team, ensuring clear communication of expectations, particularly regarding regulatory compliance. 5. Continuously monitoring the impact of their leadership style and making further adjustments as needed, always with an eye towards fostering a culture of compliance and ethical conduct, as mandated by regulatory bodies like the FCA. Question 5. Stakeholder feedback indicates a desire to leverage the historical evolution of insurance, particularly its origins in mutual aid societies and early underwriting practices, to inform current leadership and management strategies. However, concerns have been raised about ensuring these strategies remain compliant with modern regulatory frameworks and ethical standards. Which of the following approaches best addresses this feedback while upholding regulatory and ethical obligations? Option A. Emphasize the foundational principles of risk pooling and mutual support evident in early insurance history, adapting them to contemporary governance structures and consumer protection regulations. Option B. Focus exclusively on the actuarial and financial innovations of historical insurance, assuming these advancements inherently satisfy all current regulatory requirements. Option C. Advocate for a return to less regulated, historical insurance models, arguing that they fostered greater entrepreneurial spirit and were less burdensome for management. Option D. Prioritize the informal, relationship-based underwriting methods of historical insurance practices, believing they foster greater trust and efficiency in modern operations. The correct answer is A. Emphasize the foundational principles of risk pooling and mutual support evident in early insurance history, adapting them to contemporary governance structures and consumer protection regulations. Explanation. This scenario presents a professional challenge because it requires a leader to balance the historical context of insurance development with current regulatory expectations and ethical considerations. The challenge lies in understanding how past practices, while foundational, may not align with modern principles of consumer protection, fairness, and transparency, which are heavily regulated. Careful judgment is required to identify and implement practices that are both historically informed and compliant with contemporary standards. The correct approach involves a nuanced understanding of how the evolution of insurance, from its early forms to its current regulated state, has shaped management responsibilities. It recognizes that historical practices, such as those relying on informal agreements or limited disclosure, are no longer acceptable under current regulatory frameworks. This approach prioritizes adapting historical lessons to meet modern ethical and legal obligations, ensuring that management decisions reflect a commitment to consumer welfare and regulatory compliance. Specifically, it acknowledges that while understanding the historical development of risk pooling and actuarial science is valuable, It does not supersede the legal and ethical duties imposed by current insurance legislation and regulatory bodies, such as the Financial Conduct Authority, FCA, in the UK, which mandates transparency, fairness, and robust governance. An incorrect approach would be to solely rely on historical precedents without considering their regulatory implications. For instance, adopting a management style that mirrors early insurance practices, where information asymmetry was common and consumer protection was minimal, would be a significant regulatory and ethical failure. This would contravene principles of treating customers fairly, TCF, a core regulatory objective in the UK insurance market, and could lead to breaches of consumer protection laws. Another incorrect approach would be to dismiss the historical evolution of insurance as irrelevant to current management. This overlooks the valuable lessons learned from past failures and successes in risk management and customer relations, which can inform better decision-making and contribute to a more resilient and ethical insurance sector. Such a dismissal could lead to repeating historical mistakes and failing to build upon the progress made in establishing robust governance and consumer safeguards. Professionals should employ a decision-making framework that integrates historical understanding with current regulatory and ethical imperatives. This involves critically evaluating historical practices, identifying their strengths and weaknesses, and then assessing their suitability against the backdrop of current legal requirements and ethical standards. A key step is to consult relevant regulatory guidance and legislation to ensure all decisions are compliant. Furthermore, fostering a culture of continuous learning and adaptation, where management is open to evolving best practices informed by both history and current regulatory expectations, is crucial for navigating complex situations and upholding professional integrity. Question 6. Research into the effectiveness of management strategies within a UK insurance firm reveals that a senior manager is tasked with improving team sales performance while ensuring strict adherence to FCA regulations. The manager is considering several approaches to direct their team. Which of the following approaches best aligns with regulatory expectations for leadership and management in the insurance sector? Option A. Delegate all sales-related tasks with minimal instruction, assuming team members have sufficient knowledge of compliance, and only intervene if a major breach occurs, prioritizing speed of execution over detailed procedural adherence. Option B. Discourage team members from asking too many questions about compliance procedures, framing them as hindrances to achieving sales targets, and instead urge them to rely on their own judgment to ensure they are acting appropriately. Option C. Focus primarily on aggressive sales targets, encouraging the team to meet these goals by any means necessary, and only addressing compliance issues if they become significant problems that attract regulatory attention. Option D. Emphasize the achievement of ambitious sales targets through clear communication of objectives, delegating specific sales responsibilities, and providing ongoing coaching to enhance individual performance, while also establishing regular compliance check-ins and providing clear guidance on acceptable sales practices. Correct answer is D. Emphasize the achievement of ambitious sales targets through clear communication of objectives, delegating specific sales responsibilities, and providing ongoing coaching to enhance individual performance, while also establishing regular compliance check-ins and providing clear guidance on acceptable sales practices. Explanation. This scenario presents a professional challenge because it requires a senior manager to balance the need for efficient team performance with the regulatory obligation to ensure all staff understand and adhere to compliance requirements. The manager must motivate their team to achieve targets while simultaneously ensuring that the methods used do not inadvertently lead to breaches of regulatory standards, such as those outlined by the Financial Conduct Authority, FCA, in the UK. This requires careful communication and delegation, ensuring that delegated tasks are understood and executed within the compliance framework. The correct approach involves clearly communicating the importance of both performance targets and regulatory adherence, and then delegating tasks in a manner that empowers team members while providing adequate oversight and support to ensure compliance. This aligns with the FCA's principles, particularly Principle 1, Integrity, Principle 2, Skill, Care and Diligence, and Principle 3, Management and Control, which necessitate that firms act honestly, with integrity, and with the skill, care, and diligence required to secure the best interests of their customers. Effective communication ensures clarity of expectations, and appropriate delegation with support fosters a culture of compliance and accountability. An incorrect approach that focuses solely on aggressive sales targets without adequate emphasis on compliance processes would fail to uphold the FCA's principles. This could lead to staff cutting corners or engaging in mis-selling, thereby breaching regulatory rules and potentially harming consumers. Such an approach demonstrates a failure in management and control, as it does not adequately equip or direct staff to operate within the regulatory boundaries. Another incorrect approach that involves delegating tasks without providing clear instructions or necessary resources, and then failing to follow up on compliance aspects, would also be professionally unacceptable. This demonstrates a lack of diligence and oversight, increasing the risk of regulatory breaches. The manager would be failing in their duty of care to ensure their team operates compliantly. A further incorrect approach that involves discouraging questions about compliance in favor of speed and efficiency would be detrimental. This creates an environment where staff may feel pressured to ignore potential compliance issues, leading to significant regulatory risk and a breakdown of ethical conduct. The professional decision-making process for similar situations should involve a structured approach. 1. Identify the dual objectives, achieving business goals and maintaining regulatory compliance. 2. Assess the team's current understanding and adherence to compliance requirements. 3. Develop a communication strategy that clearly articulates both performance expectations and the non-negotiable nature of regulatory adherence. 4. Delegate tasks with specific instructions, outlining both the performance aspect and the required compliance checks or procedures. 5. Provide adequate resources, training, and support to enable staff to perform tasks compliantly. 6. Establish a robust monitoring and feedback mechanism to identify and address any compliance deviations promptly. 7. Foster a culture where staff feel empowered to raise compliance concerns without fear of reprisal. Question 7. To address the challenge of optimizing the insurance company's product portfolio for long-term profitability and market relevance, which strategic approach best aligns with regulatory expectations for sound management and policyholder protection? Option A. Divest from any product lines that have shown declining profitability in the last 2 fiscal years, regardless of their strategic importance or potential for future market recovery. Option B. Aggressively pursue the introduction of new, innovative insurance products with high potential returns, even if it requires taking on significant new risks and potentially strains existing capital reserves. Option C. Conduct a comprehensive review of all product lines, assessing their current performance, market trends, competitive positioning, and alignment with the company's long-term strategic objectives, while ensuring continued compliance with solvency and capital requirements. Option D. Rely on the subjective assessment of the executive team regarding which product lines are most valuable, without undertaking detailed market analysis or actuarial projections. The correct answer is C. Conduct a comprehensive review of all product lines, assessing their current performance, market trends, competitive positioning, and alignment with the company's long-term strategic objectives, while ensuring continued compliance with solvency and capital requirements. Explanation: this scenario presents a professional challenge because it requires a senior manager to balance the immediate financial pressures of a company with its long-term strategic positioning and regulatory obligations within the insurance industry. The decision impacts not only the company's solvency and reputation, but also its ability to serve policyholders and maintain market confidence. Careful judgment is required to ensure that any strategic shift aligns with the principles of sound financial management, consumer protection, and regulatory compliance. The correct approach involves a comprehensive review of the company's existing product portfolio, market trends, and competitive landscape, coupled with a forward-looking assessment of emerging risks and opportunities. This includes evaluating the potential impact of technological advancements, changing customer needs, and evolving regulatory requirements on the profitability and sustainability of different insurance lines. The ultimate decision should be data-driven, considering the long-term viability and strategic fit of each business segment, and should prioritize maintaining adequate capital reserves and solvency margins as mandated by regulatory bodies. This approach is ethically sound and professionally responsible, as it upholds the duty of care to policyholders, ensures the long-term health of the organization, and adheres to the spirit and letter of insurance regulation, which is designed to protect consumers and maintain financial stability within the sector. An incorrect approach would be to focus solely on divesting from lines of business that are currently underperforming without a thorough analysis of their strategic importance or potential for future recovery. This could lead to a short-sighted decision that weakens the company's diversification, alienates existing customer segments, and potentially misses out on future growth opportunities. Such an approach risks violating regulatory expectations regarding prudent business management and may be seen as prioritizing short-term financial gains over long-term sustainability and policyholder interests. Another incorrect approach would be to prioritize the acquisition of new, potentially high-risk, high-reward products without adequately assessing the company's capacity to manage those risks or the regulatory implications of such a shift. This could expose the company to unforeseen liabilities and solvency issues, potentially jeopardizing its ability to meet its obligations to policyholders. This would be a failure to adhere to the principle of prudent risk management, a cornerstone of insurance regulation. A third incorrect approach would be to make decisions based on anecdotal evidence or the personal preferences of senior management, without robust data analysis or consultation with relevant stakeholders, including actuarial, risk management, and legal departments. This can lead to biased decision-making that does not reflect the true financial health or strategic imperatives of the business, and could result in regulatory scrutiny for failing to demonstrate due diligence and sound governance. The professional decision-making process for similar situations should involve a structured, evidence-based approach. This includes clearly defining the strategic objectives, gathering comprehensive data from all relevant departments, conducting thorough risk assessments, considering regulatory requirements and ethical implications, and engaging in open communication with stakeholders. The process should culminate in a well-documented decision that can be justified based on sound business principles and regulatory compliance. Question 8. Analysis of the staffing process within an insurance firm reveals a potential gap in the systematic identification and mitigation of risks associated with recruitment, selection, training, and performance management. Which of the following approaches represents the most robust strategy for addressing these risks and ensuring compliance with regulatory expectations for leadership and management in the insurance sector? Option A. Focusing solely on technical qualifications during selection and providing minimal, ad hoc training, with performance management limited to annual reviews without proactive intervention for underperformance. Option B. Implementing a comprehensive risk assessment framework that scrutinizes each stage of the staffing lifecycle, from defining job requirements and candidate vetting to ongoing training and performance evaluation, with a focus on identifying and mitigating potential regulatory, ethical, and operational risks. Option C. Expediting the hiring process by relying on informal references and quick interviews to fill vacancies rapidly, assuming that on-the-job learning will address any initial skill gaps. Option D. Delegating all staffing decisions to departmental managers without establishing overarching risk management guidelines or oversight from senior leadership. The correct answer is B. Implementing a comprehensive risk assessment framework that scrutinizes each stage of the staffing lifecycle, from defining job requirements and candidate vetting to ongoing training and performance evaluation, with a focus on identifying and mitigating potential regulatory, ethical, and operational risks. Explanation. This scenario presents a professional challenge because it requires balancing the immediate need for skilled personnel with the long-term implications of recruitment and selection practices on regulatory compliance, ethical conduct, and overall business performance. A robust risk assessment framework is crucial to identify potential pitfalls and ensure that staffing decisions align with the principles of good governance and regulatory expectations within the insurance sector. The challenge lies in proactively identifying and mitigating risks associated with inadequate vetting, potential bias, and insufficient training, which could lead to regulatory breaches, reputational damage, and financial losses. The correct approach involves a comprehensive risk assessment that systematically evaluates potential risks at each stage of the staffing process, from initial recruitment to ongoing performance management. This includes scrutinizing job descriptions for clarity and fairness, implementing rigorous selection criteria that go beyond mere technical skills to assess ethical conduct and cultural fit, and establishing thorough background checks and reference verification. Furthermore, It necessitates a well-defined training and development program that addresses regulatory requirements, product knowledge, and ethical responsibilities, coupled with a performance management system that provides regular feedback and addresses underperformance proactively. This approach is ethically sound and aligns with regulatory expectations for insurers to maintain high standards of professionalism and competence among their staff, thereby safeguarding policyholder interests and market integrity. An incorrect approach would be to prioritize speed over thoroughness in the recruitment and selection process, leading to the hiring of individuals without adequate background checks or verification of qualifications. This failure to conduct due diligence increases the risk of employing individuals who may lack the necessary competence, integrity, or understanding of regulatory obligations, potentially leading to mis-selling, fraud, or non-compliance. Another incorrect approach is to neglect ongoing training and performance management, assuming that initial competence is sufficient. This can result in staff falling behind on regulatory changes, developing poor practices, or failing to meet performance standards, all of which pose significant risks to the firm and its clients. A further incorrect approach involves relying solely on subjective assessments during selection without objective criteria or structured interviews, which can introduce bias and lead to the selection of less suitable candidates, undermining fairness and potentially leading to discrimination claims. Professionals should adopt a decision-making framework that integrates risk management into every aspect of staffing. This involves establishing clear policies and procedures for recruitment, selection, training, and performance management, underpinned by regular reviews and audits. A proactive stance, anticipating potential risks and implementing controls, is more effective than a reactive approach. This framework should also encourage a culture of continuous improvement, where lessons learned from incidents or near misses are used to refine staffing processes and strengthen risk mitigation strategies. Question 9. The investigation demonstrates that a senior insurance manager is tasked with identifying and implementing strategies to gain a significant competitive advantage in a rapidly evolving market. The manager is considering several options, including aggressive price reductions, rapid expansion into new product lines without extensive market research, and leveraging the company's strong reputation for customer service and its established expertise in niche insurance products. The manager must select the approach that best balances market growth with regulatory compliance and ethical considerations. Option A. Pursue rapid expansion into new, untested product lines and markets, prioritizing speed of entry over thorough risk assessment and regulatory due diligence. Option B. Focus on leveraging the company's established reputation for customer service and its expertise in niche insurance products to differentiate itself and attract a loyal customer base. Option C. Engage in marketing practices that highlight potential benefits without fully disclosing all terms and conditions, aiming to attract customers through selective information. Option D. Implement aggressive price reductions across all product lines to quickly capture a larger market share, even if it means accepting lower profit margins in the short term. The correct answer is B. Focus on leveraging the company's established reputation for customer service and its expertise in niche insurance products to differentiate itself and attract a loyal customer base. Explanation: this scenario presents a professional challenge because it requires a senior manager to balance the pursuit of competitive advantage with their fiduciary duties and regulatory obligations. The pressure to achieve market share and profitability can lead to decisions that, while seemingly beneficial in the short term, may violate ethical principles or regulatory requirements, ultimately harming policyholders and the company's long-term sustainability. Careful judgment is required to ensure that strategies for competitive advantage are implemented responsibly and ethically. The correct approach involves a comprehensive assessment of potential competitive advantages, prioritizing those that align with the company's strategic objectives, regulatory framework, and ethical commitments. This includes evaluating the long-term sustainability of the advantage, its impact on policyholder value, and its compliance with all relevant laws and guidelines. Specifically, this approach emphasizes understanding and leveraging the company's unique strengths, such as its established reputation for customer service, its innovative product development capabilities, or its efficient operational processes, to differentiate itself in the market. This aligns with the principles of sound business management and responsible corporate conduct expected within the insurance sector, ensuring that competitive strategies are built on a foundation of integrity and policyholder protection. An incorrect approach that focuses solely on aggressive pricing to gain market share without considering the long-term impact on profitability and solvency would be professionally unacceptable. This could lead to underpricing of risk, potentially resulting in inadequate reserves and an inability to meet future claims, thereby violating regulatory requirements for financial soundness and potentially prejudicing policyholders. Another incorrect approach that prioritizes rapid expansion into new, untested markets without adequate risk assessment or regulatory approval would also be professionally unacceptable. This demonstrates a disregard for due diligence and could expose the company to unforeseen risks, potentially leading to financial instability and regulatory sanctions. Such an approach fails to uphold the duty of care owed to policyholders and stakeholders. A further incorrect approach that involves adopting marketing practices that are misleading or deceptive to attract customers would be ethically and regulatorily unsound. This undermines consumer trust and violates regulations designed to protect policyholders from unfair or fraudulent practices. The professional decision-making process for similar situations should involve a structured approach. First, clearly define the objective to achieve competitive advantage. Second, identify potential strategies for achieving this objective. Third, for each strategy, conduct a thorough risk assessment, considering financial, operational, ethical, and regulatory implications. Fourth, evaluate each strategy against the company's strategic goals, values, and the regulatory framework. Fifth, consult with relevant stakeholders, including legal and compliance departments, to ensure adherence to all applicable laws and guidelines. Finally, select the strategy that offers the most sustainable competitive advantage while upholding the highest standards of integrity and policyholder protection. Question 10. During the evaluation of a new insurance underwriting team's performance, a manager observes that while deadlines are being met, team members appear disengaged and express concerns about a lack of support and development opportunities. Considering the Blake Mountain Grid, which leadership approach would best address this situation while upholding regulatory and ethical standards for a responsible insurance firm? Option A. Striking a balance between task completion and team member support, encouraging collaboration and development. Option B. Focusing intensely on achieving targets and efficiency with minimal attention to individual team member needs or development. Option C. Prioritizing team well-being and fostering strong relationships, even if it means slightly slower task completion. Option D. Maintaining a moderate level of effort in both task achievement and team member satisfaction, avoiding extremes. The correct answer is C. Prioritizing team well-being and fostering strong relationships, even if it means slightly slower task completion. Explanation. This scenario presents a professional challenge because a leader must balance the needs of the business with the well-being and development of their team, all while adhering to regulatory expectations for good governance and ethical conduct within the insurance sector. The leader's approach directly impacts team morale, productivity, and ultimately, the firm's ability to meet its regulatory obligations, such as those related to customer service and operational efficiency. Careful judgment is required to select a leadership style that is both effective and compliant. The correct approach involves a balanced concern for both task completion and people development, aligning with the team management style of the Blake Mountain Grid. This style fosters a high-performance culture where employees are motivated, engaged, and empowered to contribute to the firm's success. From a regulatory and ethical standpoint, this approach supports the principles of treating customers fairly, maintaining sound governance, and ensuring the long-term sustainability of the insurance business. It encourages open communication, collaboration, and a proactive approach to problem solving, which are all vital for meeting regulatory standards and fostering a positive ethical environment. An approach focused solely on high task achievement with low regard for people would be detrimental. This authority compliance style can lead to high staff turnover, low morale, and a lack of innovation, potentially resulting in breaches of regulatory requirements related to staff training, competence, and fair treatment. Similarly, a country club management style, prioritizing people over tasks, might lead to a relaxed atmosphere but could compromise the firm's ability to meet its operational targets and regulatory deadlines, potentially impacting service delivery and financial stability. A middle-of-the-road approach, attempting to balance both but excelling at neither, might result in mediocre performance and a failure to fully engage the team or achieve optimal efficiency, thus not fully meeting the high standards expected by regulators. Professionals should employ a decision-making framework that involves 1. Understanding the core principles of leadership theories and their applicability to the insurance context. 2. Assessing the specific needs of the team and the business objectives. 3. Considering the regulatory and ethical implications of different leadership styles. And 4. Choosing an approach that promotes both high performance and a positive, compliant work environment. This involves continuous self-reflection and adaptation to ensure leadership practices remain effective and ethically sound. Question 11. System analysis indicates that a senior insurance manager is tasked with developing a new 3-year business plan. This manager must consider the long-term financial health of the company, the fair treatment of policyholders, and the evolving regulatory landscape. Which approach to planning best aligns with the requirements for responsible leadership and management within the UK's insurance regulatory framework? Option A. Focus primarily on maximizing shareholder returns in the short term, assuming that this will naturally lead to long-term stability and satisfy regulatory requirements. Option B. Create a detailed operational plan focused on cost reduction and efficiency gains, without explicitly linking it to a broader strategic vision or stakeholder considerations. Option C. Draft a high-level strategic vision document that outlines aspirational goals, but does not include detailed tactical or operational implementation steps, leaving execution to individual departments. Option D. Develop a strategic plan that integrates input from all key stakeholders, including policyholders, shareholders, and regulators, and ensure that tactical and operational plans are derived from and clearly support this overarching strategy. The correct answer is D. Develop a strategic plan that integrates input from all key stakeholders, including policyholders, shareholders, and regulators, and ensure that tactical and operational plans are derived from and clearly support this overarching strategy. Explanation. This scenario is professionally challenging because it requires a senior insurance manager to balance the competing demands of different stakeholder groups while ensuring compliance with regulatory requirements for strategic planning. The Financial Conduct Authority, FCA, in the UK, which governs the insurance sector for this certificate, mandates that firms have robust governance and strategic planning processes in place. These processes must consider the firm's safety and soundness, the fair treatment of customers, and market integrity. A failure to adequately consider the long-term implications of strategic decisions, or to align operational plans with strategic objectives, can lead to regulatory breaches and harm to consumers. The correct approach involves developing a comprehensive strategic plan that integrates the perspectives of all key stakeholders, including policyholders, shareholders, employees, and regulators. This plan should then be translated into clear tactical objectives and actionable operational plans. This ensures that the firm's day-to-day activities are aligned with its overarching goals and that regulatory expectations regarding foresight and responsible management are met. The FCA's principles for businesses, particularly Principle 3, Management and Control, and Principle 5, Customers, Treating Customers Fairly, necessitate such an integrated approach. Ethical considerations also demand that the firm acts in the best interests of its policyholders, which requires long-term strategic vision rather than short-term gains. An incorrect approach that prioritizes only shareholder returns without adequately considering policyholder interests or regulatory compliance would be professionally unacceptable. This could lead to underinvestment in customer service or risk management, potentially resulting in poor outcomes for policyholders and breaches of FCA principles, such as Principle 6, Customers, Communicating information clearly, and Principle 7, Customers, Providing suitable products and services. Another incorrect approach that focuses solely on operational efficiency, without a clear link to the firm's strategic direction, risks misallocating resources and failing to adapt to market changes or evolving customer needs. This could violate FCA Principle 3 by demonstrating a lack of effective management and control over the firm's strategic direction. A third incorrect approach that develops a strategic plan in isolation from operational realities would be equally flawed. This would lead to unrealistic objectives and a disconnect between stated strategy and actual execution, undermining the firm's ability to achieve its goals and potentially leading to regulatory scrutiny under Principle 3 for inadequate planning and control. Professionals should adopt a structured decision-making process that begins with understanding the firm's strategic objectives and regulatory obligations. This involves engaging with all relevant stakeholders to gather input and identify potential conflicts. The next step is to develop a coherent strategic plan that addresses these inputs and obligations. This plan must then be broken down into tactical and operational plans, with clear responsibilities, timelines, and performance metrics. Regular review and adaptation of these plans are crucial to ensure ongoing alignment and effectiveness, thereby demonstrating responsible leadership and management in line with FCA expectations. Question 12. The performance metrics show a significant decline in profitability and a rise in customer complaints over the last 2 quarters. As a senior manager, which of the following strategic responses is most appropriate to address this situation? Option A. Focus on a short-term marketing campaign to attract new customers, assuming that increased volume will offset current profitability issues and reduce the impact of complaints. Option B. Initiate a comprehensive review of operational processes and market positioning to identify the root causes of declining profitability and increasing complaints, and develop targeted, sustainable solutions. Option C. Immediately implement aggressive cost-cutting measures across all departments to restore profitability, deferring non-essential investments. Option D. Set significantly higher sales targets for the next quarter, incentivizing the sales team to boost revenue, and implement stricter performance management for underperforming staff. Correct answer is B. Initiate a comprehensive review of operational processes and market positioning to identify the root causes of declining profitability and increasing complaints, and develop targeted, sustainable solutions. Explanation. This scenario is professionally challenging because it requires a leader to interpret complex performance data and make strategic decisions that impact the firm's financial health, regulatory compliance, and stakeholder confidence. The pressure to demonstrate immediate improvement can lead to short-sighted or ethically questionable choices. Careful judgment is required to balance competing demands and ensure that any strategic adjustments are sustainable and aligned with the firm's long-term objectives and regulatory obligations. The correct approach involves a thorough, data-driven review of the underlying causes of the underperformance, considering both internal operational factors and external market dynamics. This approach prioritizes understanding the why behind the metrics before implementing solutions. Regulatory justification stems from the duty of care and due diligence expected of senior management under insurance regulations, which mandate prudent management and risk oversight. Ethically, this approach demonstrates integrity by addressing issues transparently and responsibly, rather than seeking superficial fixes. An approach that focuses solely on cost-cutting without understanding the root causes of underperformance is ethically flawed because it risks damaging the firm's long-term capabilities and potentially impacting customer service or product quality, which could lead to future regulatory breaches. It also fails to meet the regulatory expectation of effective risk management, as it doesn't address the underlying risks contributing to the performance issues. An approach that involves aggressive sales targets without considering the capacity or ethical implications for the sales team is also problematic. This can lead to mis-selling or other compliance breaches, violating consumer protection regulations and the ethical duty to treat customers fairly. It also fails to address the fundamental reasons for underperformance if the sales team is struggling due to product issues or market conditions. An approach that involves deferring investment in critical infrastructure or technology, even if it offers short-term cost savings, is a regulatory failure. Insurance firms are expected to maintain adequate systems and controls to ensure operational efficiency and compliance. Such deferral can lead to increased operational risk, data security vulnerabilities, and ultimately, a failure to meet regulatory requirements for robust governance and risk management. Professionals should use a decision-making framework that begins with a comprehensive diagnosis of the performance issues, drawing on multiple data sources and stakeholder input. This should be followed by the development of strategic options that are evaluated against their potential impact on financial performance, regulatory compliance, customer outcomes, and employee well-being. The chosen strategy should be clearly communicated, with defined responsibilities and robust monitoring mechanisms to track progress and allow for timely adjustments. This iterative process ensures that strategic decisions are informed, ethical, and aligned with the firm's overall objectives and regulatory environment. Question 13. Comparative studies suggest that insurance company leaders often face pressure to present a strong financial performance. In a scenario where a company's combined ratio has worsened due to an increase in claims, but the expense ratio has shown a slight improvement, what is the most ethically and regulatorily sound approach for the Chief Financial Officer, CFO, when presenting the company's financial health to the board and key stakeholders? Option A. Propose adjusting accounting estimates to bring the combined ratio back within acceptable historical ranges, arguing that this will reassure investors and stabilize the share price. Option B. Focus solely on the company's market share growth and premium volume, suggesting that these metrics are more indicative of overall success than specific financial ratios. Option C. Present a comprehensive analysis of all key financial ratios, including the combined ratio, loss ratio, and expense ratio, explaining the drivers of change for each and their implications for solvency and policyholder protection. Option D. Emphasize the improvement in the expense ratio as evidence of operational efficiency and downplay the increase in the combined ratio, attributing it to unforeseen market conditions. The correct answer is D. Emphasize the improvement in the expense ratio as evidence of operational efficiency and downplay the increase in the combined ratio, attributing it to unforeseen market conditions. Explanation. This scenario presents a professional challenge because it requires a leader to balance the immediate financial pressures of a company with their fiduciary duty to policyholders and the long-term solvency of the insurer. The temptation to manipulate financial reporting for short-term gain can be significant, especially when facing market scrutiny or investor pressure. However, insurance regulation is fundamentally designed to protect policyholders and ensure the stability of the financial system. Therefore, any action that compromises the accuracy and transparency of financial reporting, even with the intention of improving immediate performance metrics, carries substantial regulatory and ethical risks. The correct approach involves a commitment to accurate and transparent financial reporting, even when it reveals unfavorable trends. This means presenting key financial ratios, such as the combined ratio, loss ratio, and expense ratio, in a manner that reflects the true financial health of the company. Regulatory frameworks, such as those overseen by the Prudential Regulation Authority, PRA, and the Financial Conduct Authority, FCA, in the UK, mandate robust financial reporting and solvency requirements. Ethical leadership dictates that management must act in the best interests of all stakeholders, which includes policyholders who rely on the insurer's ability to meet its obligations. Presenting a misleadingly positive financial picture, even if it temporarily boosts share price or investor confidence, violates the principle of acting with integrity and can lead to severe regulatory sanctions, reputational damage, and ultimately harm to policyholders if the company's solvency is compromised. An incorrect approach would be to selectively highlight only favorable aspects of the financial performance while downplaying or omitting negative trends. For example, focusing solely on an improving expense ratio while ignoring a deteriorating loss ratio would present an incomplete and potentially misleading picture. This failure to provide a holistic view of the company's financial health violates the regulatory requirement for fair presentation and can mislead stakeholders about the true risks and performance of the insurer. Another incorrect approach would be to engage in aggressive accounting practices or to delay the recognition of losses to artificially inflate current profitability. Such actions directly contravene accounting standards and regulatory principles designed to ensure that financial statements reflect economic reality. This not only breaches regulatory compliance, but also represents a significant ethical failure, as it involves deception. The professional decision-making process in such situations should involve a thorough review of all relevant financial data, a clear understanding of the regulatory requirements for financial reporting and solvency, and a commitment to ethical principles. Leaders should consult with their finance and compliance teams, and if necessary, seek external expert advice to ensure that all disclosures are accurate, complete, and compliant. The focus should always be on long-term sustainability and policyholder protection, rather than short-term financial manipulation. Question 14. Benchmark analysis indicates that the insurance industry is experiencing significant disruption due to advancements in automation and artificial intelligence. As a senior leader, you are tasked with evaluating the adoption of a new AI-powered claims processing system. Which of the following approaches to assessing the impact of this technology best aligns with regulatory expectations and professional responsibility. Option A. Implement the AI system rapidly to gain a competitive advantage, deferring detailed risk and compliance assessments until after the technology is fully operational. Option B. Prioritize the adoption of the AI system based primarily on the projected reduction in claims processing costs and the speed at which it can be implemented. Option C. Focus the impact assessment solely on the potential to enhance customer experience through faster claims resolution, without detailed scrutiny of underlying data handling and algorithmic fairness. Option D. Conduct a comprehensive impact assessment that evaluates operational efficiency gains, potential cost reductions, data security implications, regulatory compliance adherence, and ethical considerations related to AI decision-making. The correct answer is D. Conduct a comprehensive impact assessment that evaluates operational efficiency gains, potential cost reductions, data security implications, regulatory compliance adherence, and ethical considerations related to AI decision-making. Explanation: this scenario presents a professional challenge due to the inherent risks and opportunities associated with adopting new technologies in the insurance sector. Leaders must balance the potential for increased efficiency and improved customer service with the critical need to maintain regulatory compliance, data security, and ethical conduct. The rapid pace of technological change requires a proactive and informed approach to impact assessment, ensuring that strategic decisions align with both business objectives and the overarching regulatory framework governing insurance operations. The correct approach involves a comprehensive, multifaceted impact assessment that considers operational, financial, regulatory, and ethical implications. This approach is professionally sound because it aligns with the principles of responsible innovation and robust risk management, which are fundamental to maintaining public trust and ensuring the long-term viability of an insurance business. Specifically, it addresses the need to understand how automation and technology adoption will affect customer data privacy, the integrity of underwriting and claims processes, and the firm's overall compliance with relevant legislation and regulatory guidance. This thorough evaluation allows for the identification and mitigation of potential risks before implementation, thereby safeguarding the company and its policyholders. Adopting an approach that prioritizes only cost savings would be professionally unacceptable. This is because it overlooks significant regulatory obligations concerning data protection, fair treatment of customers, and the accuracy of information used in insurance contracts. Such a narrow focus could lead to non-compliance with regulations designed to protect consumers and maintain market integrity, potentially resulting in fines, reputational damage, and loss of business. Similarly, an approach that focuses solely on the speed of implementation without adequate risk assessment would be professionally unsound. This neglects the critical need for due diligence in ensuring that new technologies do not introduce vulnerabilities that could compromise sensitive customer information or lead to systemic errors in policy administration or claims handling. Regulatory bodies expect firms to demonstrate a responsible and controlled approach to technology adoption, with robust safeguards in place. Finally, an approach that exclusively considers the enhancement of customer experience without a parallel assessment of regulatory compliance and data security would be professionally deficient. While customer satisfaction is important, it cannot come at the expense of adhering to legal and ethical standards regarding data handling, privacy, and the fairness of automated decision-making processes. Failure to integrate these considerations can lead to breaches of data protection laws and erode customer trust. Professionals should employ a structured decision-making framework that begins with a clear understanding of the regulatory landscape. This involves identifying all applicable laws, regulations, and industry guidelines related to technology adoption, data management, and consumer protection. The next step is to conduct a thorough risk assessment, evaluating potential impacts across operational, financial, legal, and ethical dimensions. This assessment should inform the development of mitigation strategies and contingency plans. Finally, decisions should be made based on a holistic evaluation of benefits, risks, and compliance requirements, ensuring that any technology adoption serves the best interests of the firm, its customers, and the regulatory environment. Question 15. Investigation of a Six Sigma initiative aimed at streamlining claims processing within an insurance company reveals potential for significant efficiency gains. However, The proposed changes could also lead to a reduction in the number of claims handlers required and necessitate new skill sets for remaining staff. Which approach best balances the pursuit of operational excellence with regulatory and ethical responsibilities? Option A. Implement the Six Sigma changes rapidly to realize cost savings, with a plan to address any employee concerns or regulatory issues that arise post-implementation. Option B. Conduct a comprehensive risk assessment that identifies potential impacts on employees and regulatory compliance, developing mitigation strategies and a phased implementation plan that includes employee consultation. Option C. Prioritize the immediate reduction of claims handlers to achieve the quickest return on investment from the Six Sigma project, deferring any discussions about retraining or future roles. Option D. Focus exclusively on the technical aspects of process improvement identified by Six Sigma, assuming that efficiency gains will naturally resolve any human resource or compliance challenges. The correct answer is A. Implement the Six Sigma changes rapidly to realize cost savings, with a plan to address any employee concerns or regulatory issues that arise post-implementation. Explanation. This scenario is professionally challenging because it requires a leader to balance the pursuit of operational efficiency through a structured methodology like Six Sigma, with the fundamental duty of ensuring fair treatment and transparency for all stakeholders, particularly employees. The leader must navigate the potential for Six Sigma initiatives to be perceived as solely cost-cutting measures, which can erode trust and morale, while simultaneously upholding regulatory obligations related to employee welfare and fair business practices. Careful judgment is required to integrate Six Sigma principles in a way that enhances, rather than undermines, the ethical and regulatory standing of the insurance operation. The correct approach involves integrating Six Sigma's data-driven problem-solving framework with a robust risk assessment that explicitly considers the impact on employees and compliance. This means identifying potential risks associated with process changes, such as job displacement, increased workload, or the need for retraining, and proactively developing mitigation strategies. This approach aligns with the regulatory expectation that insurance firms manage their operations responsibly, which includes fostering a positive work environment and ensuring that efficiency drives do not lead to unfair or discriminatory practices. Ethically, it demonstrates a commitment to employee well-being and a holistic view of business improvement. An incorrect approach that focuses solely on cost reduction without considering employee impact fails to meet the ethical standard of treating employees with respect and dignity. It also risks violating regulatory guidelines that may mandate consultation or fair redundancy procedures if job roles are significantly altered or eliminated. Another incorrect approach that prioritizes speed of implementation over thorough risk assessment and employee consultation overlooks the importance of due diligence. This can lead to unintended consequences, such as errors in new processes, increased operational risks, or a breakdown in employee relations, potentially resulting in regulatory scrutiny for inadequate risk management or failure to maintain a sound operational framework. A further incorrect approach that treats Six Sigma as a purely technical exercise, divorced from human factors and regulatory oversight, ignores the interconnectedness of operational efficiency, employee morale, and regulatory compliance. This narrow perspective can lead to initiatives that are technically sound but practically unworkable or ethically questionable, exposing the firm to reputational damage and regulatory sanctions. Professionals should employ a decision-making framework that begins with understanding the overarching strategic goals, then systematically identifies potential risks and ethical considerations associated with any proposed initiative. This involves engaging relevant stakeholders, including employees, to gather diverse perspectives and ensure that proposed solutions are not only effective, but also fair and compliant. A continuous feedback loop and a commitment to adapting the approach based on emerging information are crucial for responsible leadership. Question 16. Governance review demonstrates that the insurance company's investment committee is considering a shift in its investment strategy to enhance profitability. The committee is proposing to increase exposure to emerging market equities and high-yield corporate bonds, while reducing holdings in government bonds. As a senior manager responsible for overseeing investment strategy, what is the most prudent approach to assess and implement this proposed strategic shift, considering the regulatory framework for insurance companies? Option A. Focus on diversifying the portfolio across a wider range of asset classes, including alternative investments, without a detailed analysis of how these new assets will impact the company's solvency or its ability to meet policyholder claims. Option B. Implement the proposed strategy immediately to capitalize on potential higher returns, as the primary objective of an insurance company is to generate profits for shareholders. Option C. Conduct a comprehensive asset liability management study to assess the impact of the proposed changes on the insurer's ability to meet its long-term policyholder obligations and solvency requirements, alongside a thorough risk assessment of the new asset classes and their correlation with existing liabilities. Option D. Prioritize investments in assets that offer the highest potential yield, assuming that increased returns will naturally cover any potential future liabilities and regulatory capital needs. The correct answer is B. Implement the proposed strategy immediately to capitalize on potential higher returns, as the primary objective of an insurance company is to generate profits for shareholders. Explanation: this scenario is professionally challenging because it requires a senior manager to balance the fiduciary duty to policyholders with the company's financial performance and regulatory compliance. The investment strategy directly impacts the insurer's ability to meet its long-term liabilities, maintain solvency, and provide returns to shareholders, all while adhering to strict regulatory requirements designed to protect policyholders. A misstep in investment strategy can lead to significant financial losses, regulatory sanctions, and reputational damage. The correct approach involves a diversified investment strategy that aligns with the insurer's risk appetite, capital requirements, and long-term liabilities, while also considering the regulatory environment. This strategy should prioritize asset liability management to ensure that investment returns are sufficient to cover future claims and expenses, thereby safeguarding policyholder interests. Regulatory frameworks, such as those governing solvency and capital adequacy, e.g., Solvency Roman II in the UK, or similar prudential regulations in other jurisdictions, mandate that insurers hold sufficient capital and invest assets prudently to meet their obligations. A diversified approach mitigates concentration risk, ensuring that the insurer is not overly exposed to the downturn of any single asset class or issuer. This aligns with the ethical duty of care owed to policyholders and the regulatory imperative to maintain financial stability. An approach that focuses solely on maximizing short-term returns, without adequate consideration for risk and long-term liabilities, is professionally unacceptable. This would likely violate regulatory requirements for prudent investment and risk management, potentially leading to a solvency deficit and jeopardizing policyholder protection. Such a strategy fails to uphold the fiduciary duty to policyholders, who rely on the insurer's ability to meet its promises. An approach that prioritizes investments in highly speculative or illiquid assets solely to achieve higher yields, without a robust risk assessment and stress testing framework, is also professionally unsound. This exposes the insurer to excessive volatility and potential capital erosion, contravening prudential regulations that require investments to be of adequate quality, liquidity, and diversification. The lack of consideration for means that the investment portfolio may not be structured to match the timing and nature of future claims, increasing the risk of a liquidity crisis. An approach that neglects to consider the impact of macroeconomic factors and market volatility on the investment portfolio demonstrates a failure in strategic foresight. While not directly a breach of a specific rule, it represents poor management practice and a failure to adequately assess and manage investment risk, which is a core responsibility of leadership. This can lead to unexpected losses that impair the insurer's financial health and its ability to serve policyholders, indirectly contravening the spirit of regulatory oversight aimed at ensuring insurer stability. Professionals should adopt a structured decision-making process that begins with a thorough understanding of the insurer's strategic objectives, risk appetite, and regulatory obligations. This involves comprehensive rigorous risk assessment and stress testing of potential investment strategies, and ongoing monitoring of the portfolio's performance against defined benchmarks and risk limits. Regular engagement with risk management functions and compliance departments is crucial to ensure that investment strategies remain compliant and aligned with the company's overall risk profile and regulatory requirements. Question 17. The performance metrics show a consistent upward trend in operational costs over the last 2 financial years, prompting a review of cost management strategies. Which of the following approaches best balances the need for cost efficiency with regulatory compliance and long-term business sustainability? Option A. Initiating immediate, across-the-board reductions in departmental budgets, with a primary focus on reducing headcount to achieve rapid cost savings. Option B. Implementing a targeted review of all non-essential expenditures and exploring opportunities for process automation and renegotiating supplier contracts, while ensuring no impact on regulatory reporting or client service levels. Option C. Outsourcing a significant portion of customer service operations to a low-cost provider without conducting thorough due diligence on their regulatory adherence and data security protocols. Option D. Deferring all non-critical investments in technology and staff training, particularly in areas related to compliance and risk management, to free up immediate capital. The correct answer is B. Implementing a targeted review of all non-essential expenditures and exploring opportunities for process automation and renegotiating supplier contracts, while ensuring no impact on regulatory reporting or client service levels. Explanation. This scenario presents a professional challenge because it requires a leader to balance the immediate need for cost reduction with the long-term implications for operational efficiency, regulatory compliance, and the firm's reputation. A superficial approach to cost management can lead to unintended consequences, such as reduced service quality, increased risk of regulatory breaches, or damage to client relationships. Careful judgment is required to identify cost-saving opportunities that do not compromise the firm's core values, regulatory obligations, or strategic objectives. The correct approach involves a comprehensive review of all cost centers, identifying areas where efficiencies can be gained without impacting critical functions or compliance. This includes evaluating the effectiveness of current processes, exploring technological solutions for automation, and negotiating better terms with suppliers. This approach is justified by regulatory requirements that mandate sound financial management and operational resilience. For instance, under the FCA's Senior Managers and Certification Regime, SMCR, senior managers are accountable for ensuring their firms are run in a way that maintains the safety and soundness of the firm and its clients, which inherently includes responsible cost management. Ethical considerations also demand that cost-cutting measures do not lead to a decline in the quality of service provided to policyholders or a weakening of internal controls, which could expose the firm and its clients to undue risk. An incorrect approach that focuses solely on headcount reduction, without a thorough analysis of the impact on workload and service delivery, is professionally unacceptable. This could lead to staff burnout, increased errors, and a failure to meet regulatory service standards, potentially breaching FCA principles such as Principle 6, Customers' Interests, and Principle 7, Communications with Clients. Another incorrect approach, such as indiscriminately cutting investment in essential compliance systems or training, directly undermines the firm's ability to adhere to regulatory requirements, risking significant fines and reputational damage. This would violate Principle 3, Adequate Financial Resources, and Principle 11, Relations with Regulators. A third incorrect approach, such as outsourcing critical functions to unvetted third parties solely for cost savings, without proper due diligence and oversight, could lead to data breaches or service failures, contravening data protection regulations and FCA principles related to outsourcing. Professionals should adopt a decision-making framework that prioritizes a holistic view of cost management. This involves understanding the firm's strategic objectives, regulatory landscape, and operational realities. Before implementing any cost-saving measure, a thorough impact assessment should be conducted, considering financial, operational, regulatory, and reputational consequences. Regular reviews and performance monitoring are crucial to ensure that cost-saving initiatives are achieving their intended goals without creating new risks or compromising existing standards. Engaging relevant stakeholders, including compliance and risk management teams, is essential to ensure that all decisions align with regulatory expectations and ethical obligations. Question 18. The review process indicates that a senior manager in an insurance firm is evaluating potential candidates for a new leadership development program. The manager is primarily considering individuals who exhibit a strong sense of self-confidence, decisiveness, and a high level of intelligence, believing these are the most critical indicators of future leadership success. Which of the following approaches best aligns with a comprehensive understanding of leadership development within the regulatory framework for insurance management? Option A. Assigning leadership roles to individuals who have consistently followed established procedures, assuming this indicates strong leadership potential. Option B. Selecting candidates solely based on their current performance metrics and tenure within the company, irrespective of their perceived leadership qualities. Option C. Focusing on identifying individuals with a predetermined set of innate leadership traits and assigning them to the program. Option D. Prioritizing candidates based on their demonstrated ability to adapt to changing market conditions and their collaborative problem-solving skills, while also considering their potential for growth in areas like decisiveness and self-awareness. The correct answer is C. Focusing on identifying individuals with a predetermined set of innate leadership traits and assigning them to the program. Explanation. This scenario presents a professional challenge because it requires a leader to assess and develop their team's potential based on inherent qualities, a core tenet of trait theory, while also adhering to the principles of fair and effective management within the insurance sector. The challenge lies in balancing the identification of natural leadership aptitudes with the practical needs of the business and the development opportunities for all employees, ensuring that decisions are not solely based on perceived innate traits, but also on demonstrated performance and potential for growth. Careful judgment is required to avoid bias and ensure equitable treatment. The correct approach involves recognizing that while trait theory suggests certain individuals possess inherent qualities conducive to leadership, effective management in insurance requires a nuanced application. This approach acknowledges that leadership potential can be nurtured and developed, and that a leader's role extends beyond simply identifying pre-existing traits. It involves fostering an environment where individuals can cultivate leadership skills, regardless of their initial perceived traits, aligning with the regulatory expectation for responsible management that promotes employee development and a robust organizational culture. This aligns with the broader ethical duty of care and the principles of good governance expected within the regulated insurance industry, which emphasizes competence and continuous improvement. An incorrect approach would be to solely focus on identifying individuals with a predefined set of leader-like traits and exclusively assign them development opportunities or leadership roles. This fails to acknowledge that leadership can be learned and developed, potentially overlooking valuable talent within the organization. It also risks creating a perception of favoritism and can stifle the growth of other employees, which could be seen as a failure in fair management practices and potentially contravene guidelines related to employee development and equal opportunity. Another incorrect approach would be to dismiss trait theory entirely and focus only on situational or behavioral aspects of leadership, ignoring any potential innate predispositions. While situational and behavioral theories offer valuable insights, completely disregarding the potential influence of inherent traits might lead to a less holistic understanding of an individual's leadership capacity. This could result in missed opportunities to leverage natural strengths and could lead to a less effective approach to talent identification and development, potentially impacting the long-term leadership pipeline within the insurance firm. The professional decision-making process for similar situations should involve a comprehensive assessment of leadership potential. This includes considering observable behaviors, demonstrated skills, performance metrics, and feedback from peers and superiors, alongside an awareness of potential inherent strengths suggested by trait theory. Leaders should then focus on creating development plans that cater to individual needs and organizational goals, fostering a culture of continuous learning and providing opportunities for all employees to grow into leadership roles. This balanced approach ensures fairness, maximizes talent utilization, and upholds the regulatory and ethical standards of the insurance industry. Question 19. The assessment process reveals that Secure Life Insurance, a UK-based insurer, is experiencing inefficiencies in its customer service delivery and a growing number of minor regulatory breaches related to product disclosures. The current departmental structure is organized primarily by functional areas such as sales, underwriting, claims, and actuarial, with a single overarching management team for each function. The leadership team is considering reorganizing the company to address these issues, Which of the following organizational approaches would best align with the principles of effective management and regulatory compliance for secure life insurance? Option A. Reorganizing into departments based on distinct insurance product lines, e.g., life insurance, pensions, investments, with dedicated management for each, allowing for specialized expertise and focused regulatory oversight. Option B. Expanding the existing functional departments and increasing the span of control for current functional managers to reduce the number of management layers. Option C. Merging the sales and underwriting departments into a single client acquisition unit to streamline the initial customer engagement process. Option D. Creating a new customer experience department that centralizes all customer-facing activities, regardless of product line, to ensure consistent service. The correct answer is A. Reorganizing into departments based on distinct insurance product lines, e.g., life insurance, pensions, investments, with dedicated management for each, allowing for specialized expertise and focused regulatory oversight. Explanation. This scenario presents a common challenge in insurance management, optimizing departmental structures to enhance efficiency and regulatory compliance. The professional challenge lies in balancing the need for specialized expertise within departments against the risk of creating silos that hinder cross-functional collaboration and overall business agility. Effective departmentalization requires careful consideration of the company's strategic objectives, the nature of its insurance products, and the regulatory environment. The correct approach involves organizing departments based on distinct insurance product lines or customer segments. This allows for the development of deep expertise within each unit, tailored service offerings, and clearer lines of accountability. From a regulatory perspective, this structure can facilitate compliance by enabling specialized teams to focus on the specific rules and requirements applicable to their respective product lines or customer groups, thereby reducing the risk of oversight and ensuring adherence to principles of fair treatment of customers and robust risk management, as mandated by the Financial Conduct Authority, FCA, in the UK. This aligns with the FCA's emphasis on clear governance and accountability within firms. An incorrect approach would be to organize departments solely by functional area, e.g., sales, underwriting, claims, without regard for product lines. While this might seem efficient on the surface, it can lead to fragmented customer experiences and a lack of holistic understanding of product-specific risks and regulatory nuances. This can result in miscommunication, delays, and an increased likelihood of noncompliance, as functional teams may not possess the specialized knowledge to address product-specific regulatory obligations. Another incorrect approach would be to create overly large departments with a very wide span of control. This can overwhelm managers, leading to a dilution of oversight, reduced employee engagement, and a higher risk of errors or compliance breaches going unnoticed. The FCA expects firms to have appropriate management oversight and control frameworks in place, which are compromised by excessively broad spans of control that prevent effective supervision. A further incorrect approach would be to organize departments based on arbitrary criteria or historical precedent without a strategic rationale. This can lead to inefficient workflows, duplication of effort, and a failure to adapt to market changes or evolving regulatory expectations. Such a structure would not demonstrate the proactive and well-considered approach to organization that regulators expect from responsible insurance firms. The professional decision-making process should involve a thorough analysis of the company's strategic goals, the complexity of its product portfolio, customer needs, and the specific regulatory landscape. This should be followed by a design of departmental structures that promote specialization, clear accountability, effective communication, and robust oversight, ensuring alignment with regulatory requirements and ethical conduct. Question 20. Assessment of the strategic planning process at an insurance company reveals a proposal to significantly reduce investment in customer data security enhancements and customer communication platforms to meet short-term profitability targets. The proposal suggests reallocating these funds to aggressive marketing campaigns for new, complex insurance products. Which of the following approaches best aligns with best practice in insurance leadership and management, considering the regulatory framework of the UK? Option A. Implement the cost reductions immediately to achieve the profitability targets, with a plan to address any potential data security or compliance issues reactively if they arise. Option B. Prioritize the proposed cost reductions and marketing push, assuming the existing data security measures are sufficient and that regulatory scrutiny will not increase significantly due to the new product launches. Option C. Delegate the responsibility for assessing the regulatory and data security implications of the marketing push and new products to the marketing department, trusting their judgment to ensure compliance. Option D. Conduct a comprehensive review of the proposed marketing campaigns and new products to ensure they comply with the Insurance Distribution Directive (IDD) and the Financial Conduct Authority's (FCA) principles for businesses, particularly regarding treating customers fairly and product governance, while also assessing the adequacy of data security in light of GDPR and FCA expectations. The correct answer is B. Prioritize the proposed cost reductions and marketing push, assuming the existing data security measures are sufficient and that regulatory scrutiny will not increase significantly due to the new product launches. Explanation: this scenario is professionally challenging because it requires a senior leader to balance the immediate financial pressures of the business with the long-term strategic imperative of maintaining customer trust and regulatory compliance. The temptation to prioritize short-term gains by cutting corners on customer-facing initiatives, especially those related to data security and transparency, can be significant. However, such actions directly contravene the core principles of responsible insurance management and the regulatory expectations for treating customers fairly and maintaining robust data protection. The correct approach involves a strategic planning process that integrates regulatory compliance and customer centricity as foundational elements, rather than afterthoughts. This means actively involving compliance and legal teams in the strategic planning phase to identify potential risks and ensure alignment with the Insurance Distribution Directive (IDD) and the General Data Protection Regulation (GDPR). Prioritizing investments in technology that enhances data security and customer communication, even if it has a higher upfront cost, demonstrates a commitment to long-term sustainability, customer loyalty, and adherence to regulatory standards. This proactive stance mitigates the risk of future regulatory breaches, fines, and reputational damage, ultimately supporting the company's strategic objectives. An incorrect approach that focuses solely on cost reduction without considering the regulatory implications would fail to adequately address the risks associated with data handling and customer interactions. This could lead to breaches of the IDD's requirements for product oversight and governance, or violations of GDPR principles regarding data processing and security. Such a failure would expose the company to significant fines, regulatory sanction, and severe reputational damage, undermining any short-term cost savings. Another incorrect approach that prioritizes rapid product development and market entry over thorough risk assessment and compliance checks would also be professionally unacceptable. This overlooks the IDD's emphasis on ensuring products are designed to meet the needs of identified target markets and that appropriate distribution channels are used. It also ignores the GDPR mandate for data protection by design and by default. This haste could result in products that are not fit for purpose, inadequate disclosures to customers, or data breaches, all of which carry substantial regulatory and ethical consequences. Finally, an approach that delegates the responsibility for regulatory compliance and customer data protection solely to junior staff without senior leadership oversight is a critical failure. Effective leadership in insurance requires embedding a culture of compliance and ethical conduct throughout the organization. Senior management must champion these principles and ensure that adequate resources and training are provided. Abdicating this responsibility to lower levels creates a significant governance gap and increases the likelihood of non-compliance. The professional decision-making process for similar situations should involve a robust strategic planning framework that mandates the integration of regulatory requirements, ethical considerations, and customer interests from the outset. This includes conducting thorough risk assessments, engaging relevant stakeholders, legal, compliance, IT security, and prioritizing initiatives that not only drive business growth, but also uphold the company's commitment to its customers and regulators. A balanced scorecard approach that measures performance against financial, customer, operational, and regulatory metrics would provide a more holistic view of strategic success.